Hi, I'm Rusty Dornin from the Kaufman Fellows Academy and excited to welcome for his first hangout of the course, Brad Feld. It looks like we've got a really great class this time. There's a lot of discussion going on already in the forums. And Brad, already we've got questions already pre-selected for you that people have put in, which is a first. But I'm going to get a first one in before anybody else. During this funding season, I know this is a pretty busy funding season after Labor Day and that sort of thing. What trends are you seeing in terms of pitches from entrepreneurs? Are people being smarter about their pitches? Are there things you don't like? Give us an overall trend of what's going on.
I think the baseline of quality of people at all stages, not just later stages, but early stages in terms of how people are presenting their business, has gone up significantly in the last couple of years. I think there's a lot of information around it. A lot of people have gone through accelerators or have seen sort of the early stage pitch approach of accelerators. So overall, my advice to entrepreneurs is to put a lot of energy into getting good at telling your story in multiple different ways. We talk about in venture deals, having an elevator pitch all the way through having, the documentation that you'd want, when somebody's really digging into your company. But being able to tell your story in 30 seconds, in a couple of minutes, in 10 minutes, in 30 minutes, in a way that's well done and compelling and well supported is an important skill for any entrepreneur. And it always surprises me when entrepreneurs don't do it in a way that's comfortable and authentic for them. So it's very, very easy to see when you're on the receiving end of a cut and paste email. Or I got something the other day that literally at the bottom of it had the safe unsubscribe notice from Constant Contact. So it was clear that somebody had just loaded up a bunch of my email address and a bunch of other email addresses with the thing that they sent out to people. Treat it as a sales process. Use a tool like Yesware. Track who's opening your emails and what the dynamics are. Who's looking at your presentation. Take the whole process professionally, not just the actual pitch. That would be my biggest advice. The last comment I'd make is recognize that a lot of VCs are not looking to be pitched. Right? I'm actually not that interested in being pitched. I actually don't ever need to sit and look at another 30-minute PowerPoint presentation that somebody takes me through ever again in my life. Send me a short overview. If I'm interested in it, I'll tell you. And if I am interested in it, I want to use your product. I want to dig in. I want to play around with what you're doing. So understand your audience versus view all VCs as the same and assume that your approach to every VC should be similar.
And I think that's part of what we're asking people to do for the assignment too, is researching VCs for their backgrounds and that kind of thing. We'll get into that later, but we've got so many questions that people already have. I should jump into those. Real-time sports fan engagement startups seem to be pretty catchy lately. How would you personally rate this niche? Are there any special trends you see? I mean, fantasy sports is huge in the U.S., let alone the $70 billion fantasy football market.
I have no specific idea on this market. The only company we've ever invested in that we're currently invested in that has any sort of linkage to this is a company we did through our FG Angel syndicate called Blinkfire. I guess we also have an investment in a company called TeamSnap that does sort of real-time scores for high school and college sports. But each of those investments were done not because of the specific market opportunity, but because of the entrepreneurs. In the case of Blinkfire, the founder had been a founder of FeedBurner, which we were early investors in, got bought by Google. In the case of TeamSnap, it was a company in a market that we knew pretty well because of some previous history that had several large incumbents who were struggling, and this company was led by a very, very strong entrepreneur who we worked with before. So, in terms of my own experience with it, no real clue. And I think that that's a useful thing. I think there's some VCs who have very deep domain experience in certain things, and some VCs who are very broad, horizontal in terms of not caring too much about domain experience. In our case at Foundry Group, we're very focused on a set of themes. So there's a half a dozen themes that we have very, very deep experience on, and outside of those themes, we just really don't pay much attention to what's going on.
How much attention do entrepreneurs need to pay attention to facts like that? I mean, how much research should they be doing about a firm before they go ahead and pitch them? in a particular market?
I think a lot, and it's easy now. When I started my first company in the late 1980s, there was no web, and VC firms were very secretive, and nobody wrote about what they did, and you didn't even know what companies they'd invested in. And today, that information is very prevalent. There's a huge amount of market information. Most VCs have websites with their portfolios. A lot of VCs blog or tweet. There's tools like Crunchbase and Mattermark where you can do real research on who's invested in what companies and when they invested and how much they invested, not just which companies, but which people are on the board. A lot of firms talk about how they think about investing and what they like and what they don't like. So I would say put a lot of energy into it. Again, coming back to the comment I made at the beginning, treat it like a sales process. You wouldn't go sell blindly your product to this nameless, faceless audience of customers. You segment your customers, you target them, you learn about what you want to do with them. It doesn't matter whether it's a business product or a consumer-oriented product. You really try to understand the persona of the buyer. I think a mistake a lot of entrepreneurs make is to think that all VCs are the same, that there's one archetype called a venture capitalist. A VC is a thing. I actually like to describe VCs as Dungeons and Dragons characters, for those of you that are old enough to remember Dungeons and Dragons. There's lots of different character types. There's orcs and dwarves and mages and wizards and elves, and they have different skill levels and they have different powers. And venture capital firms are often collections of different characters. They're not a single thing, but they're a collection of individual partners that have different strengths and weaknesses. So do your work as an entrepreneur to understand that.
Okay, next question. You mentioned the goal of returning 3 times invested money. What ROI is actually achieved across the industry, and does it vary by fund size? How is the split between founders, angel investors, round A and round B?
Well, the venture capital business in general has a very broad distribution of returns. There's a cliche that goes around that 90% of the returns are generated by the top 20 firms, and I don't think that that's necessarily valid anymore. It might on an absolute dollar basis or a percent return basis, but it's a good heuristic, which is basically to say there's a relatively small number of firms that are extraordinarily successful, and then everybody else does somewhere between and poorly. The interesting dynamic around this is that it's not static. So, in 2007, there were a series of firms there were a series of new firms created between 2004 and let's say 2008. Ours, Foundry Group, was one of them, but they included Union Square Ventures, Spark, First Round Capital, Lowercase Capital, and these funds many of the funds in this time period have been extraordinarily successful. So they were brand new funds, and they varied in size, but they generally were smaller firms. Right? I think the first Lowercase fund was $25 million. Our fund was $225. The first round fund was $150 maybe, or $125. Union Square Ventures was $125. So these funds ended up having very significant cash-on-cash returns as well as return on investment because they had a lot of significant exits relatively early. Compared to some funds, if you're a billion-dollar fund, to get 3 times your money, you have to have $3 billion worth of gross returns, but you actually have to return even more than that because you have a net basis, right? If for those of you that understand how a venture fund works or are learning how a venture fund works, after you've returned your capital, the venture firm keeps 20% of the profits. So in the case of a $100 million fund, the first $100 million goes back to the investors, but the next $200 million, only $160 million goes back to the investors because 20% or $40 million of the next $200 million goes to the GP, to the VCs. On a $1 billion fund, those numbers start to get even bigger. Right? In addition, you have what's called a management fee. We talk a lot in the book about and in the course about the management fee and recycling the management fee or not. I've got a good blog post called "Why Every VC Should Recycle Their Management Fee," which I'll toss up separately in the course notes. But that management fee is about 15% of the capital of the fund over the lifetime of the fund. So if you're a $100 million fund, $15 million of it over 10 years gets paid to pay your salaries and your costs of operating your fund. If you're $1 billion fund, it's more like $150 million. So you have to return that capital too. So small funds have a bigger advantage in terms of this idea that one or two of the companies in your portfolio could have an outlier type return and generate that multiple. The end result, if you're like, well, Brad, that's nice, I could talk about this for an hour, and the end result of the hour is it's still pretty messy, right? It's not something that is consistent, and it's not something that you can easily look at over time because most venture firms scale up. So those funds that raised a small amount in their first fundraise, I'll use Spark as an example. I have a lot of respect for the team at Spark. Their first fund was 150, 200 million. I don't know what the number is. Their most recent fund, I think, was 500 million. And in addition to that, they've also raised a late-stage fund, which is about the same size. So they've grown as a firm compared to, say, Foundry Group, which our first fund was 225, and the third fund we raised was 225. And we haven't grown as a firm. It's exactly the same people. Or in the case of Union Square Ventures, where they've increased the size of their fund a little bit, but not very much. But they've added some additional partners as the firm has changed. So it's this dynamic phenomenon that's not static. It's not consistent year over year. And you have some firms that are extremely successful and then might have a fund that's not as successful. And then might have a fund, again, that's even more successful in the future. So the idea of trying to say what's the best, most successful category is very, very hard to zone into.
Okay, we've got our questions stacking up here. How do you actually decide what a worthwhile investment is? Apart from a good fit, excuse me, what are the things that really create value for a VC?
Well, again, think of VCs as Dungeons & Dragons characters. It's going to vary by firm, and it's going to vary by individual. So I can describe Foundry Group's strategy and how we evaluate things, and I would tell you it's very different than how another firm might evaluate things. Andreessen Horowitz probably evaluates things very differently than we do, and Sequoia probably once again evaluates things differently than we do. And a firm whose name you may never have heard of that's in Ohio, there's a firm called Drive, for example, might evaluate things in a very different way than we do. So it's going to be firm specific, and you need to understand that going in. In the case of Foundry Group, we have a very simple approach. We're early stage investors. If you've raised more than $3 million, you're too late for us. If you're outside the U.S., we don't invest, but we'll invest anywhere within the U.S. And we have a set of themes that we talk about on our website. If you go to foundrygroup.com and click themes, you'll see the themes page. If you've raised more than $3 million, or you're outside the U.S., or you're not in one of our themes, we pass. We don't even engage. So it has to. That's the first filter. So I like to say no in 60 seconds. We try to say no to almost everything we invest in very, very quickly. Or things that we're not going to invest in. We try to say no very quickly. Then we get very focused on two things. First is the product. We look at the product. We have these themes that we invest in. We understand the products very, very well. We understand the technology well. We're all nerds. We go deep on the product. We play with the product. We touch the product. We use the product. We try to understand where the product vision is going and where the entrepreneur thinks, where the entrepreneurs can take the product vision. Second, we go very deep on the people. And the first thing we're looking for is the entrepreneur's obsession with the product. We're not looking for passion. I like to say passion is a nice word, but it sort of belongs in the bedroom. We're looking for something different. We're looking for just this total deep obsession with the product. And through that, we get to know the entrepreneurs, and we're trying to evaluate whether we want to be long-term partners with them and they want to be long-term partners with us. It's a two-way street, and both are important. We may want to be investors, but the entrepreneurs may not look at us as the partner that they want. That's okay. We're happy to not be an investor in that case. There may be lots of situations where the entrepreneur really, really wants us to invest, but we don't feel like it's something we really want to do. We lose interest in the founders, or we're not as excited about them. I have three partners. There's four of us. We take a very qualitative approach to this. So each of the four of us independently meets with the entrepreneurs and spends our time separately, and we're constantly communicating during our evaluation process about what we're thinking. And if at any point along the way one of us starts to trend negative, we have a qualitative assessment where we're like, I'm losing interest in this. We pass. So it's really a case of us independently doing a lot of deep quantitative work, but focusing on our qualitative response to that quantitative work, rather than one partner doing a bunch of work, deciding we want to do that person wants to do the deal, and then trying to pitch the other partners on making the investment. That's our approach. Okay. Again, every firm is different, and understanding what drives a firm is part of the work that you should do in advance of getting to know them.
Okay. You said in a lecture that future revenue is not predictable. Only costs is what entrepreneurs have under control. How is it possible to come to realistic valuations with that being the case?
Well, for early stage companies, valuation is rarely based on revenue or any kind of financial metrics. The early valuations are much more arbitrary, and they're really driven by two things. One is sort of what the normal market tenor is for the type of business you're doing, combined with competition. So if you have multiple investors that are interested in your company, independently, your ability to negotiate a higher price for your company is increased. But at the early stages, you're still going to be negotiating typically within a certain bound, unless you're an entrepreneur who's had success multiple times, who's writing a big check as part of that financing on their own. You're going to be limited in terms of where you can go. Once you start making progress, you have metrics, including presumably revenue, that can be used to help guide valuation. But even in the early stages, it's still pretty arbitrary, and the biggest lever point that you typically have in terms of increasing valuation is to get multiple firms interested in what you're doing, because that essentially gives you a chance to have competitive offers. When you have a more mature company doing 10, 20, 30, 50, $100 million in a market segment, enterprise SaaS or advertising, the economics of your business and the historical economics start to become real trends, and the looking backwards trends become interesting. Is your growth rate steady? Is it increasing? Are your margins going up, or are they going down? Do you have consistency in your revenue growth, or is it all over the place? What is, if you have a churn dynamic for your business, what does that churn look like? What's the average revenue per user or per customer, and is that ARPU going up or going down over time? So these metrics start to be ones that can be used to value your company, but they're typically on a looking backward basis versus a looking forward basis. So you have to have enough history so that you can start to have some extrapolation from it. The last comment I'd make is I think most VCs know that most entrepreneurs, so in most cases, most entrepreneurs are overly optimistic about the growth rate of the company. Not always. There are definitely cases where the growth rate exceeds that perspective, but most of the time, what you present is overly optimistic. I can't tell you the number of times I hear the qualifier, our numbers are conservative. Don't do that. The second you say that, you're signaling that your numbers aren't conservative. It's kind of like when an investor says, I'm a value-added VC. The first thing you think is, that guy's full of shit, right? He's telling me he's value-added because he's not, right? You immediately have this reaction to the modifier. You really want your actions to demonstrate that. So if I want to be perceived as a value-added VC, whatever that means, I need to do things where the entrepreneurs say to each other, that guy Feld, really, he adds a lot of value to what we're doing, versus me declaring it. Same thing with your numbers. If you're conservative and you've got history, show me your plan from last year and show me how you beat your plan. And show me how your revenue was higher than your plan and your expenses were lower than your plan. That demonstrates that your numbers were conservative, and that builds some validity that your forward-looking numbers are probably conservative as well, versus you asserting that they're conservative numbers.
Okay. When beginning a startup from scratch, how can an entrepreneur effectively produce a viable, profitable business from idea stage, especially when told over and over again, you're too early, from the people that keep saying they are focused on early stage?
Well, welcome to the world. I think that this is part of the challenge of two things. One is understanding what VCs actually say and understanding what they actually mean. So let me separate those two. Most VCs say things like, we're early stage investors. Well, look at their history. When was the last time they made a seed investment? And they may say, well, we're not seed investors, we're early stage. Well, what does that mean? Like, the definition matters. Like, in Foundry Group's case, we came up with this very tight definition, which is that we'll invest in a company as long as it hasn't raised $3 million yet. So we've invested in some companies where there's 3 people and an idea. We've invested in some companies that just came out of Techstars. We've invested in some companies that had already raised $1 million or $2 million, but were still early and hadn't launched their product yet. And we've invested in some companies, and I'll give an example. One is called Moz, where when we invested, they were doing about $1 million in revenue already. But they'd only raised $1 million a month in revenue, sorry, so about $12 million annually, but they'd only raised $1.1 million as a firm. That had all been built on that money raised. So first is make sure that you understand what that VC means in terms of their history. The second is make sure you know what they're saying. Most VCs will not say, I'm not interested in what you're doing because it sucks. I'm not interested in what you're doing because I don't like you. I'm not interested in what you're doing because I've heard that you've got a terrible reputation and you murder babies for hobbies. What VCs will do is say things like, you're too early for us. Call us back when you've made some progress. So recognize that there's a long list of reasons why VCs pass or don't engage that are essentially them saying no, but doing it in a substance-free way. That's fine. Like, if somebody says it in a substance-free way, pressing to get substance may not be useful. If you have a good relationship with the person or somebody you know for a long time, you can say, hey, look, no bullshit. Why are you not interested? Like, I get that we're too early, but give me some feedback. But if it's somebody that, if you email me something and I respond, sorry, this is just not something we're interested in, and you send me back a note that says, well, give me some feedback. Again, I'm in this world where I'm trying to say no in 60 seconds. I get 500 emails a day. There's a high filter for us. Most of the time, the no is going to be because you don't fit in a theme. All right, so I say, look, you just don't fit in a theme. I get another email back saying, well, I looked at your themes, and here's how we fit in 3 of your themes. And even though we're in this vertical market, we're not really a vertical play, and da-da-da-da. I'm like, at some point, you're not helping yourself. Like I told you, it's not interesting to me. So you're looking for people who will engage with you versus they're just trying to say it's not interesting. They're two very separate things, and I think a lot of entrepreneurs get confused because they take the feedback as literal rather than the feedback as simply the investor saying, look, I don't want to engage. Now, is that appropriate? Is that fair? Is that thoughtful? Is it, I don't know, right? It's going to vary. Some VCs don't care. Other VCs say, no, it's actually really important to us that we give feedback to every entrepreneur we meet with. Okay, well, I can tell you that some of the firms who like to say that, I've been an investor in companies that have reached out to those firms where they've then spent time with him and gotten no feedback back other than we're not interested. So recognize that the actions and the words also don't necessarily match up. So just be cautious of that and have the appropriate filter as an entrepreneur. And by the way, don't get discouraged by it, right? You're not looking for every VC to like you. You're looking for, or every investor to like you. You're looking for an investor to like you.
Okay, according to Thomson Reuters' 2014 National Venture Capital Association yearbook, VC investments have been rapidly declining in the last 4 to 5 years. Do you feel that in your environment? And if so, why do you think that is happening?
So lagging indicators, not leading indicators. In fact, I think probably looking at historical data is not terribly helpful in the macro anyway. I've always been very suspicious of the actual data because whenever I've looked underneath the data, there's a very significant reporting bias, both over-reporting and under-reporting. It's very hard. There's no good collection of all this data. By the way, it's gotten a lot better over the last decade, but it's still got a lot of flaws. how things are categorized, whether it's private equity or venture capital. There was just another argument that just went around the web yesterday that or discussion. Mark Andreessen and Mark Suster had blog posts and tweets about, if you've raised $6 million and you're coming in and saying you're raising a Series A, that's bullshit. You're really raising a Series B. So classification of what stage. There's no standard. So start with that. Second, there's a ton of investing activity going on right now, especially at two stages. The very early stage, the seed stage, company creation stage, huge numbers of companies being created and funded with, $500,000 to a couple $1 million. And then the later stages, companies that seem to be successful or on a success path, raising significant amounts of money, and all of a sudden, the amounts of money that some of these companies are raising, are no longer 30, 40, 50 million dollars, but 50, 100, 200, 500 million dollars. Very significant amounts of pre-IPO or later stage type investing. I think when people do the numbers looking back, 2016, what you'll see is that there was actually not a decline, but there was an increase in these two categories. The middle category, which is the classical VC institutional category, the $2 million to $20 million type financing, I think that stage has been very difficult and continues to be very difficult. And I assert that as an entrepreneur, it's very hard to raise that money no matter where you are in the world. There's always a supply-demand imbalance there that's really significant. But the very early stage, the seed stage, and the very late stage is a huge amount of activity. Okay.
How do you see Fintech market performing and the appeals for U.S. VCs, LPs?
Was that Fintech, F-I-N, like financial tech?
Yes, Fintech,
okay.
F-I-N-T-E-C-H.
So like the other question earlier about fantasy sports, on Fintech specifically, I don't have a strong point of view because we don't invest in the Fintech vertical. We do have some activity there through Techstars, which we co-founded. Techstars has an accelerator called the Barclays Accelerator done with Barclays, which is very focused on Fintech, and a number of the companies there are quite interesting. But I don't have any specific sort of point of view or knowledge on the market in general. The data is that there's a lot of stuff going on, right? I mean, today, if you look at what's happening, we're finally in this transition state between credit cards and something else, and we have this phenomena going on. Not just Apple Pay, but PayPal spinning out of eBay and Square. You also have all of this alternative banking infrastructure around Bitcoin, alternative payment infrastructure, I should say, around Bitcoin, the Bitcoin phenomena, and now some very, very large banking institutions trying to figure out how to deal with these different things, all happening at the same time. So I think there's going to be a lot of change, like the idea that in my pocket I still have 4 credit cards and I have to remember my little special magic number that's not my credit card number, but it's the proof that I have my card. Come on, that's not sustainable. The idea that every day, millions of credit card numbers are being stolen from yet another online retailer, we're going to figure something else out. Something new is going to happen, and that something new will have a different set of problems.
Do you have VC firms you partner with more often than others on deals? If yes, what is Foundry Group's approach and criteria here?
There are. We have a couple of firms that we've done a lot of early stage investments with, and many that have done a seed round that then have brought it to us, and we've done the early round together with them. So those firms include True Ventures, Softtech VC, Bullet Time Ventures, which is the fund that David Cohen of Techstars has created. So we've got a spread of those. I think probably the 2 most active co-investing firms we've done at the early stages are True and Softtech. We don't co-invest with lots and lots of firms. Our general point of view is we describe ourselves as syndication agnostic, which is that we like to invest with other companies, but we're also happy to invest on our own. So we have lots and lots of investments where we've invested as the only institutional investor, and that's fine, and we're happy to continue to do multiple rounds. We're comfortable continuing to mark up different rounds as companies make progress and invest at higher prices, even if we're the only investor. I think for us, relationship with our co-investors is super, super important. So it's not that we don't ever develop any new relationships. We're certainly open to that, but we're very cautious about it because we've had so many relationships in the past through our previous fund, Mobius Venture Capital, and also just in general, where the co-investors really matter, and the dynamics between those co-investors and their ability to work as board members effectively, trust each other, understand how to make progress, really matters, and we're very cautious about it.
Well, we have a few more questions on here. It's 10:30, so I don't know. Do you have a few more minutes? Or?
Yeah, I'll take a few minutes.
Okay. Well, here's one. What does a typical Brad Feld day look like when you're not traveling?
Well, I'll tell you what today is. I woke up with my wife this morning. I meditated for 20 minutes. I went for a run with my dog. I had a call. I then drove into the office. I had a series of scheduled calls already, one about an escrow. I'm chairman of the board of a company called National Center for Women in Information Technology. We had an exec committee call. Obviously, I'm doing this hangout. I've got a call with Corp Dev at a company that's buying another company of ours that we're investors in. I'm then heading over to Jump Cloud, which is a company we're investors in, to spend some time with the leadership team. I'm then doing a Techstars Boston 1-hour video event. I then have a meeting with the CEO. I then have Techstars Boulder is about to finish, so I'm doing what's called Amnesty Night, where I meet with all the CEOs and they ask me anything they want about any investor on the planet. I tell them what I think of that investor. I then have a Startup Colorado advisory board meeting, and then I'm going for a walk with an entrepreneur that I'm close with, and then I'll go home. So that's my day.
What time do you go to bed?
Well, I'll probably get home around. My last meeting is at 7. The walk is 7, so probably 7 to 7:30. I'll get home 8:30. Given how long the day was, I'll probably go for a swim before I go to bed, just to sort of try to chill out. And I'll go to bed around 9:30, 10 o'clock, and I'll get up tomorrow morning and do it again.
All right, a couple more quick ones. What was the fastest deal you've signed or closed in weeks?
I have term sheet, from first meeting with entrepreneur to agreeing to do an investment. We've had a number of situations where it's been a week or less. My guess is there's probably cases of 24 hours later within sort of same day cycle. And then actually closing the deal, it takes about 30 days, no matter how much you've got your shit together, to actually do the legals to close the investment, although we probably closed investments in 15 days, in certain circumstances. The longest is also probably an interesting answer. We have investment, entrepreneurs who it's taken us over a year to get to the point where we agreed to do an investment.
Wow.
So, it's not that, speed is everything. It's building that relationship, and it's being persistent and continuing. And there are a number of very successful investments that we've made where we passed on the first round. So a good example would be Fitbit, which we're the largest investor in. The first time I was exposed to it, they'd already raised money from True and Softtech, those two firms I mentioned earlier, a small amount, maybe $1 million or $2 million. And I looked at it and passed. I wasn't inspired by the CEO, and I was just starting to get my mind around the notion of sort of instrumented health and devices, sort of that we could use to track a bunch of stuff. They didn't end up raising any money in that cycle. They sort of made it through with a little bit of revenue, some revenue and some debt that they raised. And I met with them, a year, maybe 9 months later. I got, both the partner at True and the partner at Softtech went after me again, saying, "Brad, this is totally for you." I said, I wasn't that inspired by the CEO, whatever. And they're like, "You're just totally misreading James, who is the CEO. I'd done a phone call with him. The body language wasn't, there." I said, "I'll do another call. Do a video call with him." I did a video call with him, and he showed me what he'd done in 9 months, and I was just blown away, like absolutely blown away what they'd done since the previous time that I'd spent any time with him. And I could tell from the phone call that he was one of these reserved, very sort of calm, deeply calm people. He wasn't diffusive. And all of a sudden, just by having the video instead of the audio, I felt a little different tone. And we dug in, and probably a month later decided to invest. It has the potential to be one of our most successful investments ever. So, as an entrepreneur, I'd encourage you build relationships. Mark Suster has a great post. He says, "I invest in lines, not dots. You know, he wants to build that relationship over time. Just because a VC says no doesn't mean that you can't develop a relationship. A lot of people say, how do you develop a relationship? Best way to develop a relationship, by the way, with a busy person, not just a VC, but a busy person, is to do something that's useful for them. Recognize that I'm on the receiving end all day long, every day, of people saying, give me this, can you do that for me, I want this, can you make this happen, can you do this? And that's part of my job, that's fine. But when somebody does something that helps me with my world, wow, that gets my attention.
Right.
So use that as a tactic.
Yeah, there was a great piece written on that. I was actually going to post it in the class, talking about trying to give somebody like you, something back, instead of just saying, hey, can I brainstorm, can I pick your brain about this?
Yep.
Do you have time for any more? It's up to you. We've got three.
Last one.
Okay, last one. Well, we got somebody. What's the best way to go about keeping in contact with you in order to receive advice and to go about applying to Techstars?
So we'll do one more after this because this is really short. Brad@feld.com is the best way to get in touch with me. I get 500 emails a day, so keep it short and to the point, but I'm happy to be responsive. Try to answer everything. Techstars, the best way to get involved and apply to Techstars is just apply. Go to techstars.com and apply. The application is actually an intelligence test. It takes about 5 minutes just to see if you can actually fill out an online web form. The application is not the meat of the process of applying to Techstars, but it's the first step in that process.
Okay, last one, and then I'm going to advise the other student to just ask you in the Ask Brad forum. But how do you go deep on people? Do you assess consciousness levels? Integral theory. He says, we do. Let me know if you're interested.
Yeah, if there's only two more, then let me do them both.
Okay.
Rusty, since we got everybody on here. So the way I go deep on people, I use it as a metaphor. I just spend time with them and get to know them, and I try to interact with them around substantive things that are relevant to their company. So I'm not doing personality tests. I'm not, asking a bunch of bizarre random questions. I'm trying to engage in working with them to solve a problem, because I want to see how he or she solves a problem. I want to see how the entrepreneur thinks. I want to see how they respond to feedback. I want to see if they're open to feedback, and I'm also interested if they are willing and able to challenge me, because I'm wrong a lot. So as part of that exploration process, it's a real give and take. I'm not looking for a particular personality type or a particular style. I would say I have a pretty wide range of people that I work with, but self-awareness is a big thing for me. I want people to be interested in improving, getting better, recognizing that they don't know everything, recognizing that they make a lot of mistakes, and I'm constantly looking for people that are evolving on that path.
Okay, last question. What are your recommendations for a young VC directly out of undergrad?
I'm a young VC. I'm assuming they're working, when they say a young VC, I assume they are part of a firm already. Surround yourself with experienced VCs. Get mentors. Figure out ways to learn from other VCs. VC used to be an apprenticeship job. Very few jobs, very hard to find a job, and most people learned by being sort of shadowing an experienced partner for a couple of years. That still happens, but it's much more chaotic now. It's not really, it's not as apprentice-oriented. So try to figure out ways to be around people you respect, whether it's because your firm has done deals with them, whether you've gotten a chance to get to know them, and again, do stuff to help them and earn their ability to spend time and help you.
All right, great. Brad, thank you so much for taking the extra time with us. If folks have other questions, go ahead and do the Ask Brad forum. Also, if you know people that are interested in taking the course, it is still open till the end of this week. We're going to enjoy having you back in a couple of weeks.
All right.
Thank you very much.
Looking forward to seeing everybody online.